Welcome back to the Finance Shark YouTube channel. In this video, we are going to tell you about 10 finance moves to make when interest rates are falling. The video is going to be amazing, so make sure you stick to the end. The 21st century is developing into an era of steadily declining interest rates. Interest rates have been at historic lows for years, and they just keep falling. In the US, the federal funds rate, the benchmark on which other rates are based, is near 0% in 2021, and the Federal Reserve has declared that it plans to keep it there until at least 2023. At the beginning of 2000, the benchmark US federal funds rate hovered around 6%. As of December 2020, it stood at around 0.09%. Before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. Failing interest rates typically mean lower returns on their savings. Whether the money is stashed in a savings account, a checking account, or a money market account, the interest earned on it will decrease. Folks who are paying off debt whose interest rate fluctuates, such as a credit card balance or a variable rate loan, will likely see a decrease in their annual percentage rate, APR. It won't affect their overall balance, the amount they owe, but it will result in smaller interest charges. Legendary investor Howard Marks says low interest rates have been the dominant theme of the financial world in the last 10 years and require some smart moves to make money in stocks in this environment. Here are 10 ways to prepare for falling interest rates. Number 10. Consider fixing your loan. In an environment where interest rates look set to be low for a long time, you may want to consider fixing the interest rate on your home loan and lock in a low interest rate. Although no one knows exactly what will happen with markets and the economy, it's fair to say in times like these, where global governments are implementing extraordinary stimulus packages to protect their economies, you can have a certain level of confidence that interest rates will remain low for some time until there's a sustained period of recovery. By fixing your home loan rate, you may have a better handle on your finances each month and be able to budget effectively for your other living expenses. This could be locking into a low interest rate mortgage or cutting the term from 30 years to 15 years. Number 9. Investment in interest rate sensitive companies. One smart way to take advantage of low interest rates is to invest in companies whose business models rely on cheap financing. To the extent that these companies can take the money they get and invest it for better returns, the lower the rate they have to pay to borrow, the more profit they have left for their shareholders. Two examples of leveraged companies are real estate investment trusts, or REITs, that invest in mortgage-backed securities, and closed-end mutual funds that issue preferred shares to boost the leverage of their common shares. Mortgage REITs are notorious for their high dividend yields, and those payouts rely on healthy spreads between borrowing costs and the interest they receive on their mortgage securities portfolios. Leveraged closed-end funds are less well known, but many of them use a similar strategy with a variety of fixed income and equity securities, issuing preferred stock tied to prevailing short-term interest rates, and then doubling down on the positions in their investment portfolios. Of course, to be successful, not only do financing costs have to remain low, but the investment these companies choose also have to have solid returns. If something goes wrong in their respective markets, not even cheap financing will save them. But if they choose their investments wisely, leveraged companies can reap huge rewards when rates stay low. Number 8. Invest in these solid banks while they're on sale. Jason Hall says, "It may seem counterintuitive to invest in an industry that benefits from high interest rates and loses some advantage when rates are low. But the interest rate environment has been a big factor in creating an excellent opportunity for investors. High-quality banks that have seen their share of prices and valuations fall sharply, largely on the global macroeconomic concerns that have played a big role in keeping interest rates so low. The good thing is, high-quality banks will be solidly profitable throughout cycles, and selling at or near the bottom of the interest rate cycle is a great way to miss the real opportunity. Owning these banks when interest rates start going back up is attractive." Number 7. Property. When interest rates are lower, owning property should become cheaper and more attractive. An investment property can provide ongoing income through rent payments and capital growth as housing prices rise. Before investing, always know the risks involved, such as buying at the wrong time, dealing with problem tenants, and coping with market downturns. Other options are also real estate investment trusts, REITs, and real estate-related stocks. Other beneficiaries of low interest rates are homebuilder stocks, because companies that build homes do better when sales are high. Low rates support higher prices, and they make it easier for purchasers to qualify for loans that are large enough to help them afford homes even in rising markets. Individual home builders have done well, The Home Builders ETF offers a diversified set of home builder stocks, yet you can also find stocks that benefit from the second-order effects of a solid housing market. These can give individual investors access to property assets that may otherwise be beyond their reach, such as large commercial properties, apartment buildings, and hotels. Number 6. Locate inefficient markets. Mark says he doesn't believe all markets are perfectly efficient, and feels investors should try to locate markets that offer inefficiency, as these markets' prices deviate from fair value, and there will be scope for a superior manager to deliver above-average returns through the application of alpha, or an inferior manager to perform below average due to the presence of what we might call negative alpha. But Mark's caution that an inefficient market does not mean it hands out money, and it doesn't mean everybody goes into that market and makes an above-average return, or an above-average risk-adjusted return. Thus, there will always be risks involved. Number 5. Boost your credit score or company's balance sheet. Strengthen your own credit score and/or company's balance sheet. As interest rates fall, so do borrow costs. A strong credit score can help you take advantage of lower interest rates, helping to mitigate the damage to your wallet. And if you own a business or are looking to start one, it may be time for some spring cleaning on the company's balance sheet. The single most important factor a bank will weigh when deciding your interest rate is your company's financial strength. The more profitable your business is, the better your chances of getting a lower rate, says Ciciola, who has negotiated hundreds of business loans with entrepreneurs in Montreal. The bank will evaluate your financial statements to see whether you have a history of profitability, how much profit you're currently making, and whether your profits are trending higher or lower. The bank will also look at how much debt you already owe. It follows that you need to show healthy, sustainable profits at your company if you want to get a lower interest rate. You should also work to reduce your outstanding debt. Number 4. Take risks to pursue superior returns. It's a good idea to focus on opportunities that can give you a real edge, rather than simply diversifying for the sake of it, says Cecilia. Look at countries where interest rates are low, and make sure your portfolio includes investments with higher returns. It's always on the lookout for unique, special opportunities where superior returns can be found. But these opportunities are hard to find, and even harder to time correctly. In other words, you may have great research showing a market is inefficient or mispriced right now, but after interest rates falling would typically be a time when there is some opportunity. Number 3. Reduce your savings rate. When interest rates fall, people who are saving money need to be aware of the impact lower rates may have on their potential returns. It's never a good idea to put all of your eggs in one basket, but when the basket is low interest bearing, you need to adjust your savings rate accordingly. You want to ensure that you are not losing money by investing at the wrong time. If interest rates fail, it's best to look at the impact of lower interest rates to your savings and see if there are better uses of the capital. Number 2. Look for opportunities where you have relative advantage. It's important to keep in mind that superior returns don't always come from just using your assets. They can also come from using your existing advantages. Your own attributes, such as your trading abilities, can provide an advantage over other investors. This is relevant when talking about things like trade execution or pricing inefficiencies. Finding the right time to act on these opportunities may prove challenging for some traders though, says Cecilia. Keep a clear head and stay focused. The only thing worse than making the wrong decision is making no decision, so don't hesitate to act on an opportunity if you feel it's right for you. Number 1. Be patient. Patience is essential when dealing with capital whose value will fluctuate. This is especially important for those who are investing capital which they need to rely on in the short term, such as retirees living off of savings, says Cecilia. If you're unable to be patient, then perhaps you need to relook at your overall investment strategy. Patience is a virtue. If you need the money, it may be better to sit on cash until the markets rebound. Do your own due diligence and manage your money responsibly. This was all for today. Hope you liked the video. Let us know your opinion in the comments section below. Do not forget to subscribe to our YouTube channel. Stay safe, and we will be back soon with another video.